Okay, let's unpack this. We're diving into their recent swirl of activities surrounding Shanthi Gears, that's Shanthi Gear on the exchanges.
Mm-hmm.
This deep dive, well, it's custom tailored for you to quickly cut through all that market noise.
Yeah, there's been a bit lately.
Right. And get a clear, consolidated view of the company's Q1 financial health and their current corporate maneuvers.
What's fascinating here, I think, is the collision of timelines.
Yeah.
We aren't just looking at one single piece of news.
No.
We have the historical, okay, albeit unaudited,
Yeah.
Q1 results from back in June 2025.
Right.
And they're sitting right next to these very immediate updates from late October 2025.
Just now, basically.
Exactly, which include things like high trading volume spikes and these looming regulatory deadlines. It creates this multi-layered picture.
It really does.
It forces us to balance that long-term stability against the immediate market sentiment.
That's right. So our mission today is kind of a knowledge shortcut for you. First, we need to quickly understand those latest financial numbers from Q1.
Yep, get a handle on those.
Second, we really have to dissect that recent market curiosity, that sudden sort of unexplained volume spike. What was that about? And finally, we have to weigh the company's established strong fundamentals against what analysts are currently saying about its valuation, because there seems to be a disconnect there.
Yeah, it's the classic tension, isn't it, between the
Right.
quality of the actual business and the price of the stock.
Exactly.
Let's maybe start with the immediate action, because
Alright.
that's what really captured the market's attention this month.
Good idea.
Uh,
Let's focus on late October 2025 then. The stock, which was trading north of 540,
yeah, around that level.
it experienced a significant, really noticeable increase in trading volume, particularly around October 21st, it seems.
That's right.
Now, when a company sees trading volume suddenly surge like that, the exchanges usually step in, ask questions.
Well,
What was Shanthi Gear's official response?
they clarified quite quickly, which is, standard good practice. The company officially stated that there was no undisclosed price-sensitive information, no PSI driving that volume spike.
Right, PSI. That's the key term.
It's a crucial distinction. It means the trading activity wasn't tied to some, major hidden operational contract or an imminent merger or any other hidden event that they were legally obligated to disclose.
Okay, so if the company itself says basically nothing to see here from our end, what does that suggest about the nature of the spike then? Is this just purely technical trading or market noise?
It points quite heavily toward anticipation and market dynamics, I'd say.
Oh, okay.
I mean, think about it. Traders knew a major corporate event was just days away.
Right, that meeting.
Exactly.
Mhm.
So the increased volume was likely fueled by, speculator buying ahead of the announced board meeting, people trying to get positioned before the news hits.
So it's almost a self-fulfilling prophecy of market excitement then.
Kinda, yeah,
Oh.
that happens.
And the corporate calendar confirms there was a specific date looming. Tell us about that upcoming meeting they mentioned.
Right. The primary focus was the board meeting scheduled for October 24, 2025.
Oh, okay.
And the specific purpose of that meeting was to approve the unaudited financial results for the second quarter.
Q2.
Yeah, Q2, and also the entire half-year period ending September 30, 2025. So yeah, that's why everyone was kind of on high alert.
Got it. And given that results announcement was coming, there would be strict regulatory requirements in place for insiders, correct, about trading.
Absolutely.
Mhm.
The trading window, which governs when company insiders, directors, key employees can buy or sell shares, that was closed. And it remains closed until 48 hours after those results are formally announced to the exchanges.
Standard procedure.
Yeah, standard measure. Helps prevent insider trading and just maintain market integrity, especially when anticipation is high, like it was in those days leading up to the 24th.
Makes sense. Before we move on to the financials, there was one other little housekeeping detail regarding the corporate structure, a reclassification request. What was that about?
Ah, yes. This is a detail from late September 2025. Coromandel Engineering requested a change in status.
Okay.
They wanted to move from being classified as a promoter to just a public shareholder.
Why?
Well, the rationale is entirely practical. They currently hold 0 shares in Shanthi Gears.
Oh, wait, if they hold no shares, why were they still classified as a promoter in the first place? Is that common?
It can be. Typically, this classification is historical, right? Based on maybe prior association or the corporate structure when the company was founded or went public.
I see.
But over time, obviously, shareholdings change. If they now hold 0 shares, their status as a promoter becomes kind of moot, doesn't it?
Yeah, it doesn't really mean anything.
Exactly. So the request is just pending approval to formalize that shift to public shareholder status. It just cleans up the corporate records, really, and accurately reflects the current ownership structure.
Right, just tidying things up. Okay, that gives us the high-stakes compliance and market context. Good. Now, let's pivot to the hard numbers from the quarter that ended June 30, 2025. We're looking at the company's statutory financial statements here.
The Q1 numbers.
Yeah, the Q1 numbers. And they reveal a genuinely fascinating situation where sales and profits told two very different stories compared to the prior year.
Yeah, this is where we shift from that market anticipation to the actual, demonstrated operational performance.
Let's see it.
So the headline for revenue was, well, a slight miss. Revenue from operations stood at 134.89 crores.
Okay.
Crucially, that marks a decline of 2.83% when compared to the same quarter the previous year.
Sales down by nearly 3%.
Okay.
In a growth environment, that usually sets off a few alarms, doesn't it?
It can do, yeah.
But here's the paradox you mentioned. The profits went up.
They did. Despite that dip in the top line, the quarterly net profit after tax, or PT.
The bottom line.
Yeah, the bottom line actually saw a pretty healthy rise of 4.76%, hitting 22.69 crores. So the company essentially earned more on every sale, even though the total sales volume or value was slightly reduced.
Okay.
The profit before tax, PBIE, was also solid at 30.62 crores, and that led to a diluted earnings per share EPS of 2.96.
This is really the crux of the Q1 story then. How do we reconcile selling less but making more profit? That just screams like phenomenal margin management. Where did that efficiency come from?
That is the critical question, isn't it? It really defines the quality of these results.
Yeah.
A 4.76% boost in profit on a 2.83% drop in sales. Well, it suggests two potential areas of strength, really.
Okay, what are they?
First, they might have achieved better pricing power. Maybe they successfully raised the price of their beers and gear products enough to offset any softer volume.
Possible.
Second, and perhaps more likely, or maybe in combination, they demonstrated superior cost control. This could mean, efficiency gains in their manufacturing processes, maybe reduced raw material costs through better supply chain management, or just aggressive control over operating expenses like admin or marketing costs. Tightening the belt, basically.
So we can infer that the management team really tightened the belt effectively, protected the bottom line, even when market demand for their products was maybe a little bit softer.
Precisely.
Yeah.
They're showing that they can drive profit through efficiency rather than just relying on sheer volume growth, which is a good sign.
It is.
However, and this is important, we must continuously remind ourselves that these Q1 results are categorized as unaudited.
Right. But they weren't just self-reported data that, no one looked at, were they? What level of assurance did the market actually get regarding these numbers?
No, you're right. They received what's called a limited review by the statutory auditors, MSKA and Associates.
Limited review. Okay. What does that mean in plain English?
Yeah, it's a vital distinction. So in layman's terms, while they didn't do the full exhaustive annual audit,
Which takes ages.
right, the auditors performed enough procedures to confirm that nothing came to their attention that would suggest the financial statements contained any material misstatements.
Okay.
Specifically regarding how they calculated their assets, liabilities, profits, the recognition and measurement principles.
So it carries a solid, though maybe not ironclad, stamp of external verification.
Exactly. A solid but limited stamp. That's a good way to put it.
Okay. And just to tie the business back to the financials quickly, the sources confirm their core operation hasn't changed, right? Still gears.
Yep. The company is singularly focused on manufacturing gears and gear products. That's their bread and butter.
Okay.
And the statutory reporting, adhering to IND AS 108 standards, confirms they don't operate or report results for separate operating segments.
Which is helpful for you, the listener or investor, because it means their risk profile is pretty straightforward, right?
Absolutely. They basically succeed or fail based on the gear market. It simplifies the analysis for sure.
Okay. So we've established the strong performance in Q1 driven by that margin management. And we've confirmed the recent volume spike was likely pure anticipation, not hidden news.
Seems that way.
Now let's connect this analysis to the bigger picture. What are the underlying fundamentals, and why are analysts sounding a little note of caution about the stock price?
Right. The fundamentals are, well, they're the bedrock here. And honestly, they look pretty exemplary.
Good foundation.
Very good. Shanthi Gears isn't some fly-by-night operation. It's backed by Tube Investments of India Ltd.,
Okay.
which itself is part of the enormously influential Murugappa Group.
Ah, right. That's a big name.
It is. That strong parentage provides instant credibility, financial stability, and probably access to capital and expertise, too.
That kind of pedigree certainly points toward long-term security. What do the historical performance numbers show? Anything impressive?
Oh, yeah. They show really powerful growth. We're talking about a phenomenal 30.9% compound annual growth rate, KGR, over the last 5 years.
Wow, 30.9% KGR. That's huge.
It is. And in addition to that high growth, the company maintains a healthy dividend payout policy.
So they return cash to shareholders.
Exactly. And perhaps most importantly for stability, it operates with minimal, almost negligible debt on its books.
Low debt, high growth, strong parentage.
Yep. These are all signs of excellent management and pretty sound fiscal discipline.
Okay, hold on. If the company is fundamentally sound, growing at over 30% a year, delivering profits even on lower sales, and carrying minimal debt, I mean, every rule in the investing playbook screams buy, right?
You think so?
So why then do the analysts we reviewed seem to consider the stock overvalued at the current sort of 540 trading level? What's the disconnect?
And this is the fascinating tension we talked about earlier.
Yeah.
The analyst reports, as of October 24th, 2025, suggest the stock is trading significantly above its intrinsic value estimate.
Intrinsic value. Okay, can you break that down for us? What does that actually mean for you, the listener?
Sure. So intrinsic value is basically what analysts calculate the stock should be worth today, based on the present value of all its future expected cash flows, discounting future profits back to today's money.
Right. So the analysts are saying the current price of 540.40 already reflects an expectation of massive future growth that, well, that hasn't actually materialized yet. Is that fair?
That's exactly it, yeah.
Yeah.
When analysts use the term overvalued, it doesn't necessarily mean the company is bad at all.
No, it's about the price.
It's purely about the price. It means the market is already pricing in a huge amount of future good news. For example, if the intrinsic value calculations suggest the stock should maybe be worth, say, 400,
right,
then the current 540 price is already factoring in perhaps 35% more growth than is mathematically justified by historical earnings or even quite optimistic future projections.
So the market has essentially baked that amazing 30.9% CAGR right into the current price and maybe even more on top of that.
It seems that way, yes. And perhaps even more. It's priced for perfection, you could say.
That raises a really important question for you, the listener, doesn't it? The market is clearly anticipating stellar Q2 results. That's why the volume spike happened, right?
Sure.
They're due right after that October 24 board meeting.
High expectations.
But if the stock is already potentially overvalued, according to these analysts, how stellar do those Q2 results need to be just to justify the current price, let alone drive it any higher?
It creates a very high bar, a really high bar.
Yeah.
The company is fundamentally great, no doubt, but the market price seems to be demanding perfection or near perfection.
Okay.
The price momentum and that volume spike we discussed earlier, driven by expectation, it seems, not new PSI.
Right.
Now, the actual Q2 results will serve as that crucial validation point. If the results are merely good or even just decent, the stock could still face downward pressure because good might not be enough to justify what looks like an overvalued premium. They probably need to be spectacular.
Got it. That sets the stage perfectly. Okay, let's try and pull this all together.
Here we go.
So what does this all mean for Shanthi Gears right now? We've seen that Shanthi Gears is a fundamentally strong, profitable company.
Definitely.
Demonstrated impressive margin management, delivering higher Q1 profits even on slightly reduced sales. That was key.
Very key, yeah.
And crucially, the recent market volume spike was apparently not driven by any new price-sensitive information.
No PSI confirmed.
Which confirms it was likely pure anticipatory market action ahead of results.
Seems the most plausible explanation, yeah.
Okay. If we connect this to the bigger picture, then.
The key conflict, really, is between the company's strong parentage Murugappa Group and that historical 30.9% CAGR on one side.
The good stuff.
Right. And the analyst consensus on the other side that the stock is currently kind of overextended and overvalued.
It's a valuation concern.
Exactly. So the immediate focus for everyone watching is entirely on the numbers that will drop after that imminent Q2 and half-year results announcement.
All eyes on the Q2 results then. Okay, and here's the provocative thought to leave you with, building on what we know about their financial reporting.
Go on.
Shanthi Gears, as you mentioned, sometimes has a history of reclassifying previous period figures for comparability purposes when they release detailed results. It's a standard accounting practice, but
For like comparisons.
exactly. So how might the detailed forthcoming Q2 half-year reports and any subsequent reclassification or maybe more detailed breakdowns of how they achieved that margin improvement in Q1 and maybe Q2, how might that affect those analyst intrinsic value models we talked about?
That's interesting. Could the details shift the models?
Could it? Especially when you balance that against the recent sort of unconfirmed volume spike driven purely by expectation. Keep watching the spread between the market price and those analyst estimates. That tension right there is the real story to follow.